So, you got a nice state tax refund last year. But this year, to your great dismay, you find that the state tax refund you got last year has become taxable income on your federal return for this year. What gives? Why is the state government sending you money only for the federal government to take some of it away? Well, in this video, I'm going to tell you why this can happen and how the taxable portion of your state tax refund is calculated. I'm the Tax Geek, back with more of your taxes, oversimplified. First of all, if you're among the 86% of taxpayers that didn't itemize deductions last year, your state tax refund is not taxable. That being said, anytime you get reimbursed for an expense you deducted in a prior year, that reimbursement becomes taxable income in the year you received it. This is called a recovery, and a taxable state tax refund is one example of such a recovery. Let's go straight to an example to see how that works. Meet Stephen. Stephen had state income tax withholding of $4,246 in 2021, which he claimed as an itemized deduction on his 2021 federal income tax return. When he filed his 2021 state tax return, he found his state tax liability was only $3,871, and as a result, the state sent him a $375 refund in 2022. Therefore, he was only entitled to deduct $3,871 on his 2021 federal return and thus was not entitled to a tax benefit for the additional $375. Therefore, the $375 tax benefit he received but wasn't entitled to needs to be recovered. This recovery is done by claiming the $375 refund as income on Schedule 1, Line 1 on his 2022 federal tax return. So you might ask yourself, why didn't Stephen just go ahead and calculate the actual state tax liability for 2021 and only deduct that amount on his federal return? Because individual taxpayers report income and deduct expenses on a cash basis. Income is always reported in the year it is received, and expenses deducted in the year paid. Also, keep in mind that it works the other way as well. If Stephen found that when he filed his 2021 state return, he had a balance due, and paid that balance due in 2022, he can deduct that balance due payment on his Schedule A for 2022. So, should you automatically include your state tax refund as income if you itemized deductions in the past year? The answer to that question is no, because part or all of your refund might not be taxable after all. The reason is that your state tax refund is only taxable if the amount of the refund actually reduced your taxable income. How much of your state tax refund is taxable is dependent on three figures: your standard deduction, the $10,000 cap on state and local tax deductions, and the amount of state sales tax you could have deducted in lieu of state income tax. First of all, your state tax refund is only taxable to the extent that the refund exceeds the difference between your total itemized deductions and your standard deduction. Let's revisit Stephen from before and suppose that he had $12,750 in itemized deductions. Since Stephen is single, his standard deduction is $12,550. Subtracting his standard deduction from his itemized deductions shows a difference of $200. Subtracting this number from his $375 refund gives him the $175 taxable portion of his state refund, because his state income tax deduction only reduced his taxable income by that amount. Next, your state tax refund is not taxable to the extent that your total state and local taxes paid exceeds the $10,000 cap on state and local tax deductions. Now let's look at Alice and Sam. Alice and Sam received a state tax refund of $1,565. Between state income tax withholdings and the property tax on their home, they paid $13,334 in state and local tax, but were only allowed to include $10,000 of that amount as a deduction on their Schedule A. Here, their $1,565 state tax refund would not be taxable, since they simply weren't allowed to deduct that amount of tax. Lastly, your state tax refund is only taxable to the extent your state income tax liability exceeds the state sales tax you could have deducted instead. As I mentioned in my video on state and local tax deductions, you can choose whether to deduct your state income tax or an approximation of the state sales tax you paid during the year, calculated using the tables in the instructions for Schedule A. This isn't a factor very often. Your potential state sales tax has to be fairly close to your state income tax liability for it to come into play. This could happen if you moved from a state with no income tax to one that does, or paid a large amount of sales tax on a major purchase. And if you did deduct state sales taxes instead of income taxes, your state tax refund is not taxable. If you received a state tax refund, you will receive a 1099-G form reminding you of the refund you received. This information is reported to the IRS. If you don't have a computer to calculate how much of your state tax refund is taxable, you can use these two worksheets from Publication 525, Taxable and Non-Taxable Income. To accurately calculate the taxable portion of your state tax refund, you need the following figures from your prior year's tax return: the total amount of itemized deductions, the total amount of state and local tax paid, whether or not it could all be deducted, your adjusted gross income, and the amount of any non-taxable income you received. If you use the same software or professional preparer as last year to prepare your return, the prior year information you need is usually carried forward. Most taxpayers don't need to claim their state tax refund as income, but for those who might, figuring out how much of the refund, if any, is taxable is an involved process that I've done my best to oversimplify. And as always, additional information and resources can be found in the video description. If you found this video informative, please give it a thumbs up and subscribe for more content. Please share this video with anyone who would find it useful. You can share your questions, comments, or suggestions in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.